Welcome back, and thanks for listening to the Adulting is Easy podcast, where we make adulting easier by making money easier. This is your host, Lauren, and I'm joined today by Landon Lovell, a certified financial planner and dedicated advocate for tech professionals to increase their wealth through financial, tax, and stock option planning. He's a partner of KB Financial Advisors, which has been specializing in maximizing stock options for tech employees since 2014. Thanks for joining me, Landon.
Yeah, great to be here, Lauren.
Our goal for today is to make adulting easier for listeners by discussing a personal finance topic, since managing money is the big part of adulting. So today, Landon, we're going to talk about selling stock to buy a house. But first, I want to do a little caveat. What we're talking about today is not just for tech employees, is it?
No, definitely not for tech employees. And, we have a specialization, expertise when it comes to stock options and equity compensation. But really, we focus on helping busy professionals. So, vast majority of our clients are W-2 employees, and buying a house is kind of one of the biggest decisions that you're going to make as an adult.
Absolutely. And selling stock is a pretty big decision too. So, but before we get into that, can you baseline what are stocks?
Yeah. So what are stocks? Stocks are, ownership within a company. And so another term that, you'll often hear associated with stocks are shares. And so before everything moved digital, you would have a stock certificate, a piece of paper that, indicated the number of shares of this company that you own. And that's one thing that kind of gets lost now that, so much of our stock investing is online and often through mutual funds or ETFs, is that when you invest in the stock market, you are purchasing a share of ownership in these individual companies, even if it's an index that you're investing in. The S&P 500 is roughly 500 individual stocks that you now own a very small percentage of.
Yep, that's a good point. So, how do you own stocks? I know you said digitally, but like where are these held?
Yeah. So typically, I have had a few clients, who go back to Granny's shares of AT&T or Walt Disney, where we had physical certificates. But most commonly now, we're going to be talking about one of the big brokerage houses. So Charles Schwab, Vanguard, Fidelity, those are probably the big three. And you've got your brokerage account there. And so when we talk about a brokerage account, we're talking about a non-retirement account. So this is an account where every year your dividends, any interest you earn is taxable to you. And then anytime you're selling the investments that you have in that account, probably also going to be taxable to you. But accounts at those institutions, and then you're buying either individual stocks or buying the stocks through, a mutual fund or an ETF.
So the brokerage is non-retirement. What are the ways to hold stocks in your retirement accounts in the US?
Yeah. So in your retirement accounts, if we're talking about an individual retirement account, a lot of times your IRAs and your Roth IRAs, they function kind of like the brokerage account. So you could be owning individual stocks within those. Your 401k a lot of times is different. Your investment choices are usually limited in your 401k at your employer. And so usually if you're owning stocks there, it's not going to be individual stocks. It's going to be, that total stock market index fund or that S&P 500 index fund. Even your target date retirement funds, which are usually the default option for your employer 401k, they're going to have, those total stock market or total international stock index funds within them.
So we've talked about what stocks are, how we might hold them. Landon, I'm an investor. I buy and
Mhm.
hold. I'm planning for my future. Why would I sell some of this to buy a house?
Yeah. So, when you invest in the stock market, unless you are a professional investor, and so we're talking about the Warren Buffetts of the world, where that is their business, is investing in the stock market or purchasing large portions of individual businesses. The vast majority of us, that's not, who we are. So we've got a career, we make our money somewhere else, and then, we got to figure out what to do with that money so that we're not losing purchasing power through inflation. And so you invest in the stock market because you need the money more in the future than you need it right now, and you want it to grow. And so eventually that changes, whether it's because you've retired and you don't have the income anymore, or you're ready to buy a house. Eventually you need that money now. And so when you're thinking about buying a house, there's a lot of reasons why you would look to say, okay, how am I going to come up with this down payment? I've got this brokerage account, I've got some gains here, I've made some money. It definitely could be the right move to make to sell those stocks to buy that house. And especially now with, where home prices are and how much they've went up over the last 5 years, and then how much interest rates have changed. Just a lot of the traditional advice that I gave clients prior to 2020 about buying that first house. It's different now because all of the numbers have changed around that home purchase decision.
And I would assume the advice 4 or 5 years ago was save up the down payment, put it in a high yield savings account, put down 5% and get in there. I mean, that
Yeah.
was a totally fine move back then. Right?
Yeah, absolutely. It was a totally fine move. And even putting down 5%, when
Yeah.
interest rates were that low, we were looking at how can we minimize the amount of money that you have to put down. And if you're saving that down payment up and you can get in for only 5% down, that's perfectly fine then when interest rates are less than 4%. But now that we're back to more normal interest rates over 6%, it completely changes everything, because now it's going to be a question of how much more is that monthly payment going to be than my current rent? And does that monthly payment even fit into my budget with my paycheck and my salary?
There's a big difference between for every $100,000 you borrow, you're paying 3 grand a year to I'm paying 7,500 per
Yes,
year. That makes put another $100,000 down seems like a pretty good move sometimes, you know?
it does. And this is the question, that clients have been asking over the last year, because for a lot of them, buying a house has been something that they've wanted to do for a while, that we've talked about. But even before interest rates changed, the price you were having to pay was so high that it was still like, is this the move that I want to make right now? And so they're coming to me and they're going, hey, we know you said, you know, this much for a down payment, 30-year fixed rate mortgage. But now with these interest rates, we're not sure that that works anymore. And so now, in a lot of cases, it's like, okay, how can we come up with more money to put down? Because instead of wanting kind of, 80% on the mortgage and 20% down, now it's how can I get a mortgage payment that actually works in my monthly budget?
Yep, absolutely. So, for people who are thinking about starting to save for a house, would you recommend them put their down payment in the stock market? Or is this conversation for people that already have some stocks, maybe have some down payment, but maybe should augment by selling the stocks they already have? Who's this conversation for?
I think this conversation is for someone who is trying to figure out how they augment their down payment. If you're saving the down payment and you think that the house is something that you might do this year, but you'll definitely be doing by the end of next year, just keep saving, and get your 5% on your money market. Don't go into the stock market. So
Yeah.
this is more for someone who, you know, their life has kind of reached the point where they're ready to buy the house. Like it's definitely, the personal move that they want to make to become a homeowner. And now it's just how do we make it work? And for them, if you've got the stocks to sell, definitely a good time to be thinking about selling those to make, that home purchase happen.
In your opinion, what's the, I want to say hurdle rate, but I don't know if that's the right terminology. What's the interest rate where it doesn't make sense to put more down for you compared to having the money in the stock market?
Yeah. And even that one's hard to answer, to give like a definitive, like a rule of thumb, because it's both sides. It's what is the purchase price that it's going to take, and, and what's the interest rate on the mortgage. So what I'm telling my clients right now is, it's okay to put more than 20% down to get a mortgage payment that, that works for you.
Yeah.
And then, when interest rates drop by a percentage, definitely by 2%, whenever that happens, we're going to want to reevaluate this choice. And we may even in that future look at doing a cash out refi to kind of undo some of what we've had to do now to make this home purchase happen. Because overall, I'm a big believer in 30-year fixed rate mortgages, because I mean, that's a tremendous amount of risk that that lender is willing to take on for you, and a lot of variables that you don't have to deal with. And then whenever you decide, you want to sell the house or pay the mortgage off, things change, you can do that. If interest rates go down, you can refinance. But if interest rates go up, like those of us who are sitting still on the less than 4% mortgage, it's just a huge, huge advantage.
Do you think people should be kicking themselves or feeling discouraged by the interest rates today? Because I think some people are feeling that way. And that may cause them to be like, I'm just not even going to do it.
Yeah. So, and in situations like this where it's like what I could have done, like if I could go back to 2021 and buy the house, like I always acknowledge that those feelings are definitely real, and like this really happened. Interest rates went up faster than they ever have gone up before. So everything that you're feeling and this whole experience is very, very real. But should I buy a house right now is kind of one of the toughest questions that I deal with as an advisor. And so in working with my clients, I like for them to be in a place where, like, yeah, if you want to buy the house, great, go ahead and buy the house. That's a plan that works for you. But if you don't want to buy the house, or if you're still renting right now, like there's still a plan there that works for you. So before interest rates went up, the question I was getting is, am I missing out by not buying a house? And I go, for a lot of those clients, well, you're renting and you're saving. You know, as long as you're saving, no, you're not missing out by not buying the house. And now the question is kind of the reverse. I really messed this up, didn't I? I really missed out by not getting in before interest rates went up. And it's still kind of the same thing. No, hey, if you want to buy the house, then we can probably find a way to make that work. It's just different now. And now, there is a possibility where your rent is going to be lower than, it's going to be really hard for us to match that rent with a mortgage payment. And so we're
Absolutely.
kind of back to a different version of the same thing, where it's like, it's okay for you to rent and save, as long as you're
Yep.
able to make that work for you.
You make the best decision you can with the information you have at the time.
That's it.
And it's been weird the last 4 years. Like,
Mm-hmm.
with some weird crap that's gone on that you could not have possibly predicted. So I don't think people should be kicking themselves for buying or not buying. I'm sure there's some people that bought that maybe thought they were going to miss the boat and maybe they wish they didn't. So I'm sure it goes both ways.
Yeah, it definitely goes both ways. And on the whole, across the nation, real estate values have went up on the whole across the nation. There are places like some of our clients in San Francisco, in California, where, they got the low interest rate, but then things changed and they needed to
Yeah.
make a move. And in 2022, we were
Yeah.
having to make tough decisions about the price that they could sell the house at. So there's always ways that this can, can kind of work against you, or, things can kind of go wrong for you. So you just try to identify what are kind of my financial strengths in the situation that I'm in right now. How do I best leverage the opportunities that I have? And if you want to buy a house and you've got the stocks to sell, then stock market's at an all-time high, and there's nothing wrong with making that choice that this is, I need this money now. Let me sell these stocks. Let me go ahead and get a down payment together that's large enough for me to be able to buy the house.
What about taxes on stocks?
Yep. You got to be aware of what's going on with your taxes. And so that's what I always tell clients, be tax aware. So it's not be scared of taxes, it's just be tax aware. So when we talk about taxes very rarely tell us what we should do. And a lot of times that's what clients will try to do is like, I'm going to figure out the taxes and that'll
Yeah.
tell me what to do.
Yeah.
So you decide what you want to do, and then taxes will tell you how to do it. So in each individual situation, if you're selling stocks to buy a house, we're going to figure out kind of the different combinations around taxes to determine specifically how we go about selling those stocks to buy that house. So when you're selling stocks, you want to be aware of capital gains tax, which are either going to be long or short term. They're long term if the stock has been held for 1 year and a day. They're short term if the stock has been held for, less than a year and a day. And so it's really important to pay attention to your acquisition date, the date that you purchased the stock, and then to pay attention to the date that you're going to sell. So that if you're real close to that line between short and long term capital gains, that you're making sure you're on the right side of that
Because
line.
the difference could be, say, 15% to
Yeah.
28 or something like that.
Yeah, and it scales, based on the dollar
Right.
amounts that we're talking about. So I have witnessed situations where a couple of days, cost someone $80,000 in taxes. And so you have to pay attention to
Ouch.
your dates. Details matter,
Yeah.
and it's important
Jeez.
to be organized, because there's no going back, like around that particular issue. You're going to get a 1099-B when you sell stock. The acquisition date and the sales date's going to be reported. And so there's no going back and saying, I'm sorry, this was a mistake. I didn't mean to do this. You're going to be on the hook for that. So you really want to pay attention. And the key is just knowing that anytime you're selling something, in this case, stocks, that, you need to kind of have your spidey sense as an adult going off and saying, okay, I've potentially got a tax issue here that I need to pay attention to. And hopefully you're working with someone who can, make you aware of what that tax outcome is. And hopefully even before you make the decision.
Can you pay the taxes right then? Like have them take and
Yep.
so let's say you were going to sell $150,000 worth of stocks, and let's say your taxes on it are say 20, I don't know. Can
Mhm.
you just take 130 and have the 20 just go so that you're not slammed later?
You cannot. So there is no withholding on selling stock. And there's no way to automate that to say, like, just take 10% and make my life easy. Um, so what we do for our clients is sometimes before, definitely after we've had a large transaction like that, we're going to do a tax projection, which is where, like, it's May 23rd or it's May, here's what you've done so far and you sold this stock. Okay, if we just play out the rest of the year, this is what we expect your tax bill to be next April. And so we identify what it's going to be. And then the next question is, do I pay it now or do I just wait till
Right.
April? And so in some cases, you want to pay it now because you could run into an underpayment penalty. In other cases, it's fine to wait till April. But some, clients are like, no, I've got the money right now. I just want to be done with it. Like, let me go ahead and pay it and not have to worry about, that amount being owed next April.
What about 401k loans from a down
So
payment?
yeah, 401k loans can be it's an option. It would be down my list of options that I would explore, just because of some of the specifics around how 401k loans work. So I'm not a huge fan, but um, the thing about buying a house, regardless of how you get the down, just regardless, that first house, I had this conversation with a client yesterday because this is now the second time that they're attempting to buy the first house. And in each case, there were different things that they were like, I just don't know, am I making the right move? I don't really like what's going on here. All these little specific things, that all kind of fall under the category of doing what it takes to make it happen. And what I told them is, look, I don't care what, you know, I don't care who you are, how much money you have, the specifics of the house. That first one, there's always going to be stuff that just makes you go, should I do this? Am I doing the right thing? That all kind of just fall under that category of all this like stuff where you just don't know. The second house, in my experience, is usually easier and smoother. I don't know why. It's just kind of what I've experienced in working with clients. So 401k loans are down my list, not a fan, but almost everyone that I know, my friends, myself, my clients, you kind of have this experience of buying that first house, where my friend, he bought his first house when he was in his 20s, a long time ago. And he said, like we closed and then I took the keys and I went and unlocked an empty house. And it was like, what did I do? Like, this is it. I don't have anything else other than this house.
Yeah, been
Hmm.
there. What about how do they phrase it? Can you what about first time home buyer stuff and taking money out of my retirement scot free? Is that a thing?
Yep. Yeah. So if it's scot free and you can avoid the 10% early withdrawal penalty, then yeah, absolutely. The problem with with a lot of those, and it's been a while since I've looked into the specifics and checked, but the last time I checked on this, I think it was $10,000 is what you were allowed. I'm not
That's
sure
what
if they've
yeah,
increased it.
that's the last thing I saw too.
Yeah. When they originally did that, you might have been taking $10,000 out to buy a $100,000 house.
Yeah.
So $10,000 on a $500,000, $750,000 house, it just becomes, it doesn't really move the needle. So
Closing costs, maybe?
it's there, it's there, and if you want to take advantage of it, great. Um, you with that one, you're avoiding the early withdrawal penalty. You're probably still owing the tax, so you just want to be aware of kind of
Right.
how that one works for you.
Yep. That's a good point.
Mhm.
Is your primary home an asset?
Oh, it definitely is. Your primary home is an asset. Your primary home's unique because it's an asset and it's an expense. Um, so things that I like about being a homeowner is first the leverage of a fixed rate mortgage. So, for 10, 20, 30% down, you're going to get 100% of the appreciation on that piece of real estate. And over the long term, that plays out in really big and interesting ways on your balance sheet or your net worth statement. I also like building home equity through paying a mortgage. For clients who struggle to save money, they tend to be really good at paying their bills. And the mortgage is always kind of the first thing to get paid. And so home equity is kind of very powerful. thing for a lot of people. So you got to be able, when you buy your first house, that first year is probably going to be pretty tough. It's just a huge change. Um, and there are a lot of unpredictable things that start to happen with adjusting to that change. So get through the first year. And then, um, once you get out 4 or 5 years, that's when things start to move in a positive direction, usually as a homeowner, like you're building equity. The home has appreciated. Now, I bought my first house in 2008, so I've experienced kind of the reverse of all of this stuff. So there is another side to that choice. But the thing that I can say is buying a house is a good choice, and the longer you stay in that house, the better that choice becomes. That's kind of the two rules of thumb I operate by.
Is there anything else you want to add, Landon, before we wrap up?
No, nothing else that I want to add. Adulting is easy. I love the kind of the title and the topic, and being organized about your finances and thoughtful about the choice to buy a house. I think those are kind of the two kind of fundamental behaviors around making your money a little bit easier.
How can people get in touch with you?
Yeah, so kbfinancialadvisors.com. We produce a lot of content on our blog there, and it's super easy to visit our website to schedule a call and to spend a half hour kind of sharing your situation with me and seeing if it would be a good fit for us to work together.
All right, I'll put that in the show notes along with your LinkedIn profile. You can follow me on Twitter X at Adulting is Easy, Instagram at Adulting is Easy Real. This will also be on YouTube if you want to check it out over there. If you like this episode, you'll also like episode 90, Stock Market History with Brian Feroldi, or 115, Dividends with Dividend Dream. Thanks again for listening, everybody. Hopefully, Landon and I have made adulting a little easier for you.